So as of the market close on March 11th, 2022, the United States stock market as measured by the S&P 500 has dropped more than 11%, meaning that we are in a correction. So some of you may be wondering what to do with your own investment portfolio. And so today I want to talk to you about why having a long-term investment philosophy in a boring portfolio of low-cost funds is likely still going to be the best way for you to secure your retirement. And any other methods are likely inferior because they will either require a lot of luck or will likely put you behind. So if you're interested, stick around. Welcome, my name is Jason Koh. I'm a certified financial planner and founder of Co-Planning Group. I work as a fiduciary to provide retirement planning and investment management services for Cantonese and Mandarin speaking families living in the United States. If you would prefer to listen to this video in Cantonese or Mandarin, I have those videos right here and in the description below. So let's get started. So today I will be going over 4 illustrations provided by Dimensional Fund Advisor, which is a fund company I admire very much and use for my clients' investments. They talk about why the stock market is certainly a place where you want to have a portion of your retirement because they can provide long-term growth potential given that you understand and can tolerate the risk involved. So the first one we have here is a chart that talks about the long-term average and how the annual returns rarely meets the expected average. What you'll see here is the annual returns from 1926 all the way to 2021. And this gray bar right here shows a range of 8 to 12%. And you've heard it over and over again that the long-term average of the stock market has been about 10% a year. And that is the average that we find over this time period in the S&P 500. But as you can see in this chart, the annual returns rarely meets the average. And in fact, only 7 out of the past 96 years actually had annual returns ending in between the 8 to 12% range. So you see here, 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 these 3 over here, and this one right here. Most annual returns fall out of that range, and they can be as high as over 50% or as big as a 40% drop. Another notable thing is that some of the losses can accumulate and ends up with a pretty big drawdown. So during the Great Depression, we had 4 consecutive years of losses, and they're pretty bad. And at the beginning of 2000s, when the tech bubble burst, there were 3 consecutive years of losses as well. And out of the 96 years, 25 years have ended up with a negative return. But that's actually a really good thing because it tells us that out of the 96 years, 71 years ends up being positive. So about 3/4 of the time, historically speaking, the S&P 500 has actually provided a positive annual return. So if this table shows anything at all, is that the long-term average can be very attractive, but the road is very bumpy. And on a quick side note, I've heard some people tell me that 10% is not a very high rate of return, but I actually think that it's a very good rate of return given that you don't have to do anything, it's very tax efficient. 10% a year can turn $1 into 2 in 7.5 years, and $1 into 4 in another 7.5 years, so 15 years, and $1 into 8 in the span of about 21 years. I mean, $1 doesn't sound too significant, but when you think about saving $100,000 and over time having it become $800,000, that's pretty significant. So let's move on to the next one. So this will be a little shorter. This one shows that historically speaking, after a market decline of 10, 20, or 30%, the market has generally provided positive return. And I think this is a very important chart to talk about because very often I come across people who always find a reason to stay out of the stock market. The stock market loses 10%, well, I'm going to wait until it goes down further. Or the stock market's gone up 20%, well, it's at a new high, so I'm going to avoid and wait for a dip. And I'm here to tell you that the contrarian approach of actually always finding reasons and to be optimistic about the stock market is likely the better approach, and this chart will show you why. So historically speaking, during the same time period of 1926 to the end of 2020, after a 10% decline, 1 year later, the market has actually provided a positive 11% return. Well, that just gets you back even. 3 years later, it ends up providing a cumulative growth of 32%. 5 years later, a cumulative growth of 68%. But what about if the market is scarier and it drops even more? 20 or 30% decline shows a similar trend of positive 1, 2, and 3 year returns. And even after a 30% decline, right, it can look very, very scary. And the returns are not as high, but they're still positive. So I would always recommend clients to have a more optimistic view when it comes to being a stock market investor. So this only shows the average return. So there have been periods where after 3 years, the annual return is not a positive 50, but it's a negative, right? When you look at individual data sets like that, those kind of data will always scare you. But if you look at the average, what this teaches you is that after a market decline, sticking with your investment plan is still likely going to be the best approach to allow you to have the best recovery. So let's move on to the next one. I really like this chart because it shows the same data. It's the same period from 1926 to the end of 2020. But instead of showing you the annualized returns, it shows you the return of different cycles. So above the line, these are your bull markets. Below the line, these are your bear markets. So remember when back in the Great Depression, we had 3 years of consecutive losses. Well, this shows you what the drawdown is, and it accumulated to an 80% drop. But when you kind of look at this little recovery right here of 21%, which only lasted for 4 months before it dropped even more, this entire drawdown, I think, is more significant. It ends up being about 85%. So that's very scary, right? A dollar turns into 15 cents. But this chart shows, I think, a few very big insights that are important for stock market investors. In the 95-year history that we see in this chart, there have been 17 bull markets, which have averaged to be 10 months, not even a year, and they range between 20% drop to 80%. Pretty scary. But on the flip side, on the bull market, there have been about 18, and they've lasted on an average of 54 months, 5 times longer. They range between a low of 21% to a high of, wait for it, 936%. So if you started in 1946 with about $10,000, that would have turned into close to 100K. That's pretty significant. And you only had to suffer through a negative 22% loss for 6 months before having another growth cycle that grows 144%. So here comes the third lesson of the day. Bull markets tend to be more moderate growth, but very long and accumulates to be very significant growth. And bear markets, they tend to be very painful, but again, very short, about 10 months on average. So I think this shows us that it's not a good idea to wait for a dip because you could be waiting for a very, very long time. 181 months would mean that over a 15-year period, you would have constantly been waiting for the next big crash. And when it does actually happen, you only had 6 months to react. So don't wait for the dip. If you can, continuously save money into your retirement accounts and don't try to time the market. If markets are good, there's a good chance they may continue to grow. If the markets are falling, that's a great time to buy when things are cheaper. So for the past 3 charts, we've looked at the time period from 1926 to 2020. And let's look at some more recent examples. So it shows the same annualized return that we've seen in previous charts. But this chart shows a new piece of data, and that is the biggest drop within that same year, or intra-year decline. Some are pretty minor, like a negative 3%, a negative 7, negative 6, but some can be pretty severe, right? Negative 29, negative 33, negative 49 at the bottom of the trough in the financial crisis. Despite every single year, the S&P 500 has had a drop. 16 out of the past 20 years in this data set has actually been positive. Only 4 years here ends up with a negative annual return. And I think this is particularly important now. The stock market has dropped about 11%. So we've seen this kind of data before, right? Negative 11, negative 12, right? Negative 12, negative 10% back in 2012. Right? At the beginning of 2007, it dropped 10%, but it ended up with a positive 5% growth here, 16% here, broke even at this year, a positive 13% here. And things could get worse in the short term. They always can. There's always risk. It's a coin flip whether the market goes up or down in the short term. But over the long term, I think it would be a mistake now if people sold out of their stock market portfolio just because we've seen a negative performance so far year to date. And I want to talk about how some of the years can have very bad returns but ends up with phenomenal end of the year results. So in 2003, we finally hit the trough of the tech bubble burst. It dropped 13%, but it ended up the year, had you started at the beginning and stuck through it, you you would have ended up with a positive 31% growth. And then coming out of the Great Recession in 2009, you still had a negative 20% drop from peak to trough, but that year ended up with a positive 28% growth. And within 2020, when the pandemic caused the country to shut down initially, within 1 month, the stock market fell 33%. And that was a very scary time. And I did have clients calling me, begging and suggesting and asking to get out of the stock market or at least reduce the risk in their portfolio. But knowing what I know, I suggested to stay the course. And even to my surprise, the losses only lasted a month before it rebounded and ended the year with a positive 21% growth. That really surprised me. So this leads to the fourth lesson of the day. Fluctuations are going to be a normal part of a retiree's investment journey, and it should not be a cause for you to panic. And especially the fact that rarely do retirees have all of their money in the stock market. You can always balance out the risk using high quality investment grade bonds, US Treasuries, Treasury inflation protected securities. There are always ways to dampen the risk in your portfolio. But over the long term, I think it's a mistake if people completely avoid the stock market just because of the inherent risk involved and how bad it could look. So today I talked about the historical US performance that showed positive return despite the fluctuations that investors experience. Even Warren Buffett suggests most people invest in the S&P 500 as opposed to Berkshire Hathaway, his own company, or other investment approaches. So in a future video, I'll talk about a little bit more about how I structure my investment portfolio for clients and why I include overseas stocks and also fixed income to improve the diversification, lower the risk of my clients' retirement portfolios, and to help them achieve a better outcome. So if you or your parents prefer to speak Cantonese or Mandarin and would like professional guidance on topics like Social Security timing, how to reduce investment-related taxes, and just to double check to see if you have enough retirement savings for a lifetime of retirement, please check out coplanetgroup.com to check out my services, my fee structure, and to book an opening for a free consultation and really just for you to get to know me a little better. Thanks for making it to the end. I'll see you next time.